financial flexibility and the use of other financing tools.
The primary concern of financial managers when facing long-term financing decisions is how a financing decision today might impact future financing options. 60% of respondents to a survey cited financial flexibility as the primary concern when making debt policy decisions. 42 In particular, firms wanted to protect their credit rating and to preserve unused debt capacity to finance future investment opportunities. It is thus no surprise that financial managers consider off-balance sheet financing tools to meet their capital funding needs. It is increasingly important for firms to remain flexible and to be able to adapt quickly to a changing environment. This means that the old, physical asset-intensive model may not work as well as it did in the past. Firms need to raise capital to purchase long-term physical assets that may be hard to sell in a timely manner. Raising capital is costly because debt financing increases the leverage ratio and equity financing can dilute shareholder value. However, some financing tools do not have to be classified as either debt or equity, and can thus be kept off a firm's balance sheet, thereby preserving the leverage ratio. Examples include operating leases and off-balance sheet entities for joint ventures, or research and development partnerships. Off-balance sheet financing has been attractive to many firms, especially when the addition of a large amount of new financing would break their debt covenants. However, firms should be fully aware of both the positive and negative consequences of using these instruments. Although they can have a positive effect when used to improve leverage ratios or financial flexibility, they can also lead to legal consequences if used to artificially manipulate financial reports, as was the case with Enron. Enron created several off-balance sheet entities known as SPEs, whose financial statements did not have to be consolidated with Enron's own statements. Unprofitable assets were then transferred to these entities to hide losses and make the company look financially healthy. After several accounting scandals in the early 2000s, both the Securities and Exchange Commission and the Financial Accounting Standards Board, FASB, increased disclosure requirements for off-balance sheet financing instruments. Two commonly used off-balance sheet instruments, leases and SPEs, will be explained in detail in the following sections. Leases. A recent SEC study estimated that total, undiscounted, cash flows associated with off-balance sheet operating leases for active U.S. issuers may approach $1.25 trillion. This is 28 times more than the $45 billion of on-balance sheet capital leases. 43 For companies in the S&P 500 stock index, off-balance sheet operating lease commitments, as revealed in the footnotes to their financial statements, totaled $482 billion. 44 From a financial viewpoint, the purpose of operating leases is to lower the conventional way of reporting debt. Under current U.S. accounting rules, GAAP, there are two types of leases: operating leases and capital leases. For a company to record a lease as a capital lease, the lease must meet one or more of the following four criteria: 45. 1. Transfer of ownership test. The lease transfers ownership of the property to the lessee by the end of the lease term. 2. Bargain purchase option test. The lease contains a bargain purchase option. A bargain purchase option allows the lessee to purchase the leased property for a price that is significantly lower than the expected fair value of the property at the date the option becomes exercisable. 3. Economic life test. The lease term is equal to 75% or more of the estimated economic life of the leased property. However, if the beginning of the lease term falls within the last 25% of the total estimated economic life of the leased property, including earlier years of use, this criterion shall not be used for purposes of classifying the lease. If the lease period equals or exceeds 75% of the asset's economic life, the lessor transfers most of the risks and rewards of ownership to the lessee. Capitalization is therefore appropriate. 4. Recovery of investment test. If the present value at the beginning of the lease term of the minimum lease payments, excluding that portion of the payments representing executory costs such as insurance, maintenance, and taxes to be paid by the lessor, equals or exceeds 90% of the fair market value of the leased property, then LSE should capitalize the leased asset. Because if the present value of the minimum lease payments is reasonably close to the market price of the asset, the lessee is effectively purchasing the asset. If the lease qualifies as a capital lease, it is reported as a leased asset on the asset side of the balance sheet and a lease liability on the liability side, and the effect is the same as a purchase with borrowing. This will in turn affect the total amount of debt and the calculation of the leverage ratio, cost of debt, and cost of equity. As a result, firms with a high level of debt would prefer not to have a capital lease and may prefer to have an operating lease instead.